Peter, thank you very much for coming back on the channel. We've had some great success in videos we've done in the past and provided lots of value. So I wanted to come on and obviously have another chat. Today's video, we're going to talk about joint ventures because it seems to be a hot topic of people getting into the property industry, working together. So really, the first question is, what are the key things that people need to think about when they're getting into property as a joint venture with someone else?
Okay, Justin, well, nice to be here again. It's nice to talk to you. So if we're talking about joint ventures, I think, first of all, you've got to get in your head what your investor wants. Does your investor want purely interest from their money, or do they want a share of the profits? So what you've got when you've got a joint venture, you've got someone doing the work. There's you putting the sweat in, sorting these properties out, and you've got someone else with some cash that's going to give you the money to allow you to do that. Now, you as the sweat owner, the worker, effectively, you've got to find out from your investor, what do you want? Do you want interest on your money? Do you want something better than you'll get in the bank? If that's the case, what you're really looking to do with that investor is say, right, you give my company a loan, and I will give you a return of interest.
Yep.
And that return of interest, could be 10%, much better than you get in the bank. But actually, for you as the person building and doing the investment, paying 10% for that cash is quite reasonable.
Yeah.
So if you find an investor that wants that and they just want a pure return, then you go down the route of a loan from the investor gives a loan to your company.
Yeah.
And you're going to, within the company, pay that investor a return interest on that loan. As you've seen before, what happens with that interest. If a company is paying interest to an investor, the first thing it has to do is deduct tax from the interest and then pay across the net to the investor.
Yeah, which was really useful actually. Yeah, that you could come in, help me fill in the CT61
form that needs to be done. Yeah, so you need to know that when you're doing that. Under that route, obviously, you've still got 100% of the shares in the company.
Yeah,
it's still your investment. You own that company. The investor just comes in with his cash. You pay him the interest, and at some stage, you repay him his loan, and then he leaves that buy-to-let SPV for good. Yep. So that's one route, and that will work for lots of investors. But you will, as you've probably found as well, that you will want investors that say, right, Justin, I can see you could do this, but I want to have a share of the profit. If that's the case, what you're really looking at doing is most likely it's going to be for one property, isn't it? And what you're probably going to do is set up what we call a temporary buy-to-let SPV. You're going to set up a buy-to-let SPV just for this one project. And that buy-to-let SPV is going to have you as a shareholder and your investor as a shareholder. Yep. And within that, the investor's going to chuck some cash in. Again, most likely as a loan, because within your agreement, we might come on to agreements in a minute, within your agreement, you're going to pay him back that money he's given to you before you share out the profits. So you're going to have a company with two shareholders, you and the investor. The investor puts in a loan. The company is going to buy the property. You're going to put your sweat in to sort out the property. He's put his cash in to allow you to do it. And at the end of the day, you've redeveloped that property and you've sold it on. And the profits then would be distributed to the shareholders. Let's say it's a 50-50 arrangement with you and the investor. You'll get 50% and he'll get 50%. But before those two 50% are paid out, he's repaid his loan.
And then the company's terminated.
And then at that stage, most likely the company's terminated. But you might find that actually this has worked really well with that investor. You terminate that agreement. You get to the point you've paid everything out on that property and you decide to do another one.
But could you do one where you the intention is to buy 10 buy-to-lets with someone? Is it a very similar format? You set up a joint company together 50-50, or is there anything different there?
Yeah, I mean, again, it could be that you do one. And at the end of that, rather than take all the money out of the company, pay personal taxes to get money from the company into your hands, rather than do that, you both say, well, actually, now we've got a fund of money in the company. We've got that fund of money, plus whatever the investor's willing to put back in. Maybe we could do this with 2 properties or 3 properties because we built up a bigger fund. And you could start to build your portfolio with your investor that way. Of course, the upside of that is you've got investor money to help you grow it a bit quicker. The downside is that you only own 50% of the total.
Yeah.
So you've got to bear in mind as the person putting all the effort in,
Yeah.
how much of that do you want to give away to your investor?
Sure, because you might pay nothing on the interest of the loan, obviously 0%, but then you're
You
sacrificing
might,
50% of your rental profit in the future and the gains. I
yeah,
guess.
yeah. So it could be very, very expensive money to you. He lends you, let's say, £50,000.
Yeah.
Ordinarily, let's say there was 10% interest, you'd pay him £5,000 and give him his money back. Just cost you £5,000, and you go down the route of, well, both of you own shares. You make £50,000 out of redeveloping that property. He's got 25,000. You've got 25,000, but you put all the sweat in to do it.
Yeah.
Actually, his return now is £25,000 on his £50,000 investment.
Yes.
So you've got to look carefully at which one works for you and which route works for the investor.
Yeah, which again comes down to thinking long term as well, rather than just thinking about the now, thinking about what's it going to look like in 5 years, 10 years. But just before we go any further, a quick message from today's sponsor, the Zeus app. Estate agents, listen in. You need to join the Zeus app. This is a virtual valuation tool for sales and lettings. Prospective vendors and landlords come onto the app and they upload their property information. You can then review it and give your opinion on the value and put forward your proposed fees. Hundreds of estate agents are already using the Zeus app and they are winning valuable business. So join today or email Nick using the information in the description below. And thinking along those lines, if someone was to go down that route and they go, they meet a partner who's going to potentially fund it, or maybe they fund it together and they are planning to buy 10 properties in a company together as 50-50 shareholders, what are the documents that someone needs to think about or put together in order to do that?
Right. Well, this is pretty much the same as any business. If you've got two people coming together to run a business, it makes sense that you document down what each of you are supposed to do, what each of you are required to do, and what will happen if things go well. How will things be shared out? But most importantly, what will happen if things don't go as you expect? So if you can, before you ever start this project, if you can document down this, in legal terms, this is called a shareholder agreement.
Yeah.
But you can write a shareholder agreement yourself, as I think you've done in the past. You can write a shareholder agreement yourself. It's just a matter of listing out with your fellow partner shareholder what is likely to happen and what would the result be if that did happen. So if you do this before it ever happens, so you get down and you say, right, what's the effect if one of us wants to leave? What happens? Write that down beforehand. Have that piece of paper, ideally just both of you sign it to say you agree to it,
Yeah.
so that then in the future, if we get to that point in the future and your investor says, I'm off, I can't stay in this anymore, you bring out the piece of paper and you say, this is what we agreed before we started. If you wanted to go, I would find another investor, or you would wait for your money until I'd sold the project.
So there's a clear decision-making process.
Yeah, and it's much, much easier to do that before any of those events start. When you're thinking rationally, there's no pressure from finance, there's no pressure from the build costs.
Yeah.
You write it down in the first place and say exactly what will happen,
Yeah.
and both of you agree to that. Then in the fullness of time when it happens, you've got a document that you can refer back to. This was our agreement between the two of us. If this was to happen, that's how we'd solve it.
Interesting. That's a really important fact, because you don't need it, I guess, to set up a company.
No, you don't need it. But the
have it.
difficulty, if you don't have it, you think one thing and your investor thinks something else. So we get down that line. Your investor wants to go. He thinks you're going to repay him his money immediately.
Yeah.
And you can't do that.
Yeah.
So it then becomes a problem.
Yeah.
But if you've written that down in the first place and thought about all those things that could go wrong and put that on that list, then that's all you really need. Now, in an ideal world, you might well get a solicitor to look through that so that they can be certain you've thought of everything. Mm-hmm. On top of that, if you pay for a shareholder agreement with a lawyer, you've probably got a bit of comeback if they get it wrong.
Yeah.
If they've forgotten something, you'll probably go and sue them.
Right.
So there is a small advantage in that, but it's not a necessity that you have a lawyer involved in that. If you know what you're doing and you think of all the eventualities, you can write that piece of paper yourself.
Fine. Okay. No, good. Well, I think that was really valuable for anyone thinking of using private investors to start with or joint ventures, because at the end of the day, when it comes to growing a property portfolio, money is a finite thing, and we all get to the end of it at some point. So they're very useful strategies to use when growing a portfolio. But I think that was a really useful video. Thank you very much for coming on and covering those topics. And I'm sure I'll see you again very soon.